Welcome to another 21 Hats Dashboard. I'm Lauren Feldman, and I'm here with Gene Marks. Happy Monday, Gene.
Hello, Lauren. I'm fresh back from Yellowstone National Park, baby. Can't recommend it enough. Anyone who's listening right now should definitely plan a trip to Yellowstone.
Were you there for the closing taping of the Yellowstone episodes?
We stayed right outside of the park in a little town called Gardner, Montana. And boy, you go in November and you pretty much have the park to yourself.
That's a good tip.
So no crowds, no traffic. And we saw bison, we saw bear, we saw wolves, coyotes, elk, antelope. We saw bald eagles.
How close were you to the bear?
Far enough that it was okay. But I got news for you. We went on a couple of hikes with bear spray. And I wasn't too happy about it. Everybody's like, it's fine. You'll be okay. There's nobody around in November. It's pretty empty. And you go through the woods there and you're like, Jesus, I don't know. But so.
Well, I'm glad you made it back.
Yeah, made it back in one piece.
All right. So, Gene, every year you write about and we talk about last minute moves that business owners can make to reduce their tax burdens for the year. And I always hear from owners who really appreciate the guidance. So, I guess, first of all, is there anything different this year that you would call our attention to right off the bat?
That's a really great question. And it's the only thing that would be different is some of my comments that I have on the Inflation Reduction Act. That's relatively new. But for the most part, the advice, this is from a Philly Inquirer column that I just did last week. And I interviewed a couple of accountants. And by the way, as a CPA and one who covers, I could have pretty much written this without interviewing, but they like me to be a reporter. So, and usually every year it's like the same kind of stuff. But
sure, but we all need the reminders.
We do. We need the reminders. And I also like, I like having this conversation now where we're in the middle of November, because there is still time to do something, and I oftentimes get asked to come on TV, for example, to talk about last minute tax tips on December 31st. You know what I mean? Which is insane. So I'm glad we're having the conversation now. And to get to that, yeah. So the Inflation Reduction Act, that's the new. We can get to some of the other stuff, obviously, but there are tax credits available, and they are for businesses, not just individuals, for installing energy efficient equipment and renewable energy sources and having sustainable building practices. There are tax credits if you use electric vehicles, again, in your business. Remember, even if you have a personal vehicle, you can get a significant tax credit if you buy it. And then, you might use half of it for business use. That's okay. So it is, that's a new thing.
Are there any things you need to be concerned about? What makes it okay?
Yeah. So when you're as an individual, you can buy a car. When you buy the car, you have an individual use. And if you have a business use of the car in your small business, as long as you're tracking the expenses related to it, you can deduct the expenses related to your car for business use. I've done that for years. I mean, I have a car and I use it obviously for personal use, but then I use it a lot for traveling around to clients, and whatever. And over the years, I always track it and I keep track of my gas expenses. Sometimes people use mileage rates, which is also fine. But you
could deduct the expense of buying the car when you first bought it?
So you can. If you buy a car and it's half used for your business, you can allocate half of the cost of that car to your business, and you can use that as a capital asset and depreciate it as part of your business. So again, you've got to have the documentation to support it. And along with that is the tax credit. Now, the government, what we found with the IRS, they've been pretty lenient about taking advantage of the tax credit. So for example, say you buy a car, your individual car, and it's an electronic vehicle and you get a $7,500 tax credit, which by the way, you can take that now right at the dealership against the cost of the car. So that's a big discount that you can get on it. You took advantage of that credit personally, but you still, if you're using your car 30% for your business and you want to allocate, your expenses for the car, you can also be doing that as well. Do you know what I'm saying?
Yep.
You don't have to claw back any of the tax credit or any of that kind of nonsense. Again, the IRS is not being very stringent about that rule. They want you to, the tax credit is available because it's motivated to get an EV. And that's what the government wants, is encouraging you to do. So that's why I would encourage people to do that. Do you own? Do you have a hybrid or a EV car?
I do
have?
not. I have a relatively new Honda, about a year old, but it's not a hybrid or a EV.
Yeah, neither do I. I have a regular gas guzzler. I mean, listen, I mean, I only shower like maybe twice a week, so I do save the environment there, But when it comes to my
Too
car,
much information, Gene.
Yeah, I'm hurting the environment. The other thing is I live in the city, so I can't plug the car in anywhere. It's a lot harder.
That would be a concern, wouldn't it? You're talking about the Inflation Reduction Act and the credit because of that, but there's also the capital equipment deduction. That's Section 179, I believe. And can you do that on top of the Inflation Reduction Act? Can you do both?
You can actually. If you buy capital equipment, you can take advantage of the credit, and then whatever is left that you didn't get the credit for, you can use that as your deduction. So let me back up a little bit, okay? So the Section 179 deduction, it's capital equipment, right? So you buy capital equipment up to $2 million for an item, and
what's capital equipment?
Oh, like machinery, equipment. It can't be real estate. It can be a lot of furniture and fixtures, and it can be software, computer hardware.
Could be the car.
It can be a car. Autos are a part of that as well, so you can use that. And when you get it, you take a first year deduction for it. And some people, they can either take that 179 deduction. There's also been something called bonus depreciation, where if you reach a deduction limit, it's a total of about $3 million. You can take even additional deductions for bonus depreciation, but those have been starting to get phased out as the Tax Cuts and Jobs Act from 2017 has been expiring. But the bottom line is that for the most part, for most small businesses, you can buy up to about $3 million total in capital equipment during the year, and take that deduction in the first year, as long as you put that equipment into service. So you can't just buy it and park it, or stick it away somewhere. If you buy a piece of equipment, machinery, hardware, software, an automobile, it's got to be used before the end of the year. It's got to be in service. And then you can take that full deduction for it this year. That's a big deal. That really is.
Do people really check to see if you've put it in service?
Well, if you ever get audited, yeah. I mean, there's ways, I guess, to go and check and see. I mean, if you buy a piece of equipment on December 30th and it doesn't get delivered until January 5th, then the assumption is it was not put into service and you shouldn't be deducting it. And I think that's where people get into trouble, is when they do last minute things like that. And then it's just, to the naked eye, you can just see, well, there's no way that was put into service. So you got to be careful on that. But to your other question, if you do buy or invest in equipment that's energy efficient, if you do get tax credits from the Inflation Reduction Act, so it reduces the cost of the equipment or your vehicle, for example, you can still take advantage of the 179 deduction for the remaining amount of the purchase, So these are all things. And this gets back to, not making the decision on December 31st. It's the middle of November. So if you've got some capital equipment plans, go and do it and put it into service and take that big deduction now.
In your piece, you also mentioned something that I found intriguing, which is that another way to save on your taxes is to contribute more to health insurance for your employees. Explain that.
Yeah, that's a little tax trick that another CPA taught me a couple of years ago. And I interviewed Ray Minich, who's a CPA in the Philly area, confirmed it. So the average raise, according to Mercer and a few other HR consulting firms, the average raise in 2025 will be about 3 to 4%. That's what they're estimating. Okay. It might even be in last year, ADP was reporting that average salary increases were 4.8%. So we're somewhere in that 3 to 5% raise. Okay. Range. So if you give your employees just a raise on their salary, they will get taxed on that because it's compensation. And not only will they get taxed on it, but you will pay employer taxes on that as well. So that's the way it is. If you want to avoid those taxes, instead of giving your employee a raise of that amount, or maybe you do it for half that amount, you instead contribute more to their health insurance. Because when you contribute to an employee's health insurance, they don't get taxed on that on that contribution, you get a deduction for it as well. So you're avoiding paying employer taxes on it, and the employee is not getting taxed on that healthcare contribution. They're getting more paid towards their healthcare, so they're still getting that amount, and their net paycheck is still higher. So everybody walks away net better and saving on taxes if you just allocate more towards health insurance as opposed to just straight out salary. It's an interesting little trick.
It's really interesting. Have you ever tried that? Have you done that?
No. And I should.
I wonder how employees respond to it. I mean, I can imagine it makes perfect sense, but you can imagine some employees thinking, wait a second, are you trying to get away with not giving me a raise here?
Yeah. You know what's funny these days? So first of all, in my company, full disclosure, we don't contribute to our employees. We have healthcare insurance, but we don't contribute to it. We're not a big business and we just can't afford to do it. And frankly, not a lot of our employees participate in it anyway because they have other plans and better plans with their significant others. But in addition to that, I've given this advice countless times to clients and to people that I speak to, and I'm not sure I know any that's actually taken it.
That's really interesting.
It sounds good.
It does.
And they're always like, yeah, okay, fine. And then when it comes time to give a salary increase, they just do what they've been doing. So it's one of those things.
That's really intriguing. I'm gonna ask around about that and see if I can get somebody interested in it, or at least explain why they wouldn't do it, which would be interesting too.
Right.
Another thing you mentioned is that drives CPAs crazy is when their clients don't pay their estimated taxes on time. I was surprised to see that because I kind of thought I was the only one who did that.
Who don't pay them on time?
Yeah. Is that more of a widespread thing than I realized?
Yeah, everybody. I mean, come on. You. One of the many things that I love about you and your organization and this podcast is that you're fully transparent. So tell me, why don't you pay? I'm not saying you're avoiding taxes in any way, but why sometimes do you not pay it on time? Is it just forgetfulness or is that by design?
Well, first of all, let me tell you, I've really made a point this year to pay it on time, which I have in fact done. So I have taken it seriously. In the past, I've had a career where I've gone back and forth a little bit between being an employee and having this business now that I'm trying to run. So sometimes I delude myself into thinking, well, I'm probably not going to have to, so I don't have to worry about it. It's probably laziness is the best explanation.
It is. So you hit on that. A lot of it's laziness. A lot of it is people hate to pay taxes. Just in general. A lot of it is cash flow. Like
Sure.
You got to pay in your estimated taxes, and you're like, I don't have the money to do that. It's all tied up in receivables and inventory. You know what I mean? So people have a lot of reasons why they don't pay their estimated taxes in on time. I'm guilty of it as well. I've done that a couple of times where I've delayed it. One of the things that I do to mitigate that is I'm pretty close with our accountants. In fact, I quoted a guy named Mitch Gerstein in this piece, who is my accountant. He's a tax director at his Dana and Company in outside of Philadelphia, and I share with them my P&L for my company on a quarterly basis, and we adjust our estimates. I mean, remember you have to pay in either 110% of your prior year's taxes or 90% of your current year's taxes. So if I'm having a slower year, I've been known to go to them. I've worked with them for 10 years and say like, you know what, we're not having as good a year as we had last year. So do I need to be paying in all this estimated taxes? If we readjust the calculation, and more often than not, we'll redo the calculation. Be like, yeah, you can pay in less than estimated taxes if your year is slower and still meet the requirement. You know what I mean? So that's what I've done. But some people just blow it off entirely, and it drives accountants bananas because it's not only do they have to be subject to penalties for doing that and late payment fees and all that, which is just giving money to the government for no reason at all. But, it makes life so much harder for your accountant, and then it just puts you more and more in a hole, as the year goes on. So, the big piece of advice is pay your estimated taxes timely and, and work with your accountant because you don't have to pay the same amount every quarter. It depends on how your year is going.
That's a great point, because my accountant usually just gives me a set fee to pay, quarterly for the rest of the year, and I don't really think about it. But it does make sense to check on that. I think the other reason why I haven't done it is because there's nowhere, nothing reminds me that I'm going to have to pay a penalty, and it's only when the penalty comes, and I got one, and that's why this year I made the payments. But I think, probably for other people, the fact that the penalty isn't an obvious thing. It's not like everybody knows your taxes are due on April 15th or whatever. They don't know what the percentage is, what they're going to have to pay. So it's easy to let it slide.
It's true. And you're absolutely right. It's not like you're getting a late payment notice from the IRS. You just don't know about it until you actually file and pay your taxes at the end of the year. So that kind of seeps through. But I don't know, Lauren. I mean, come on. I mean, you ask anybody who's been running a business for a while.
Right.
You get it. You know what I mean? Like, this is not a mystery, and it's not a, oh my God, there's a penalty if we pay late, So,
but it won't be that much.
Yeah, but it won't be that much. So it's just, it's common sense. And for anybody who's been running a business, we know we should be paying our taxes in timely, but yet we still need our accountants to beat us up about it.
One other thing, you had another item in your piece that intrigued me, in which you suggested that there can be advantages if there's a partnership that owns the business to reallocating the earnings.
Yeah.
Explain that.
Yeah, it was a very good point that Ray Minnick, again, one of the CPAs that I interviewed, brought up. He was pointing out that, like, if you have a business, and a lot of small businesses are partnerships. He gave the example of a business that's like, say it's you and your spouse, and he gave me a specific client situation where, you're running the business with the spouse, and then you equally pay each other. So, you have $120,000 in compensation, and each of them get $60,000. And he's like, depending on the job responsibilities and the roles, you may want to really consider reallocating the compensation so that one of the owners gets paid significantly more than the other. Again, it's got to be within parameters. But if you're able to do that, first of all, the one owner who's getting paid more than the other will more quickly reach the limits of, FICA, for example, you know what I mean?
Right,
and even
right.
state unemployment taxes, so that certain amount of their salary won't be taxed after that. So that's number one. And then number two is, that one person, if they're getting paid a lot more, they'll be entitled to more in Social Security, whereas the person being paid less, there are like minimum amounts of Social Security that get paid out. So again, using his example, he's like, listen, if you're a husband and wife and you're making $120,000 a year and, you're both just splitting it equally, you may be hurting yourself from a tax standpoint. You should really, because particularly if one of the spouses really isn't, doing much, or the other's doing a lot more than the other, you really may have a good basis for allocating a lot more income salary to one of the partners, and there are advantages for doing that.
On the other hand, couldn't this kind of test the strength of the marriage? I mean, I don't want her getting more Social Security payment than me. What?
Yeah, it's funny. Well, listen, hopefully the money's going in the same bank account, so both can see the Benjamins.
Anything you're working on this week that we should look for, Gene?
Yeah, I wrote for Entrepreneur, which I'm writing it now, actually, about paid time off. I'm revisit. I love that topic, Lauren. PTO, and how it is. This comes. It's all about unlimited paid time off, and I'm giving a bunch of reasons, like 10 reasons why every business should consider an unlimited paid time off plan. So I'm having kind of fun writing that.
Is it because employees never actually take the time that they...
There's 10 reasons you're going to have to read those. I think that happens to be one of them. And which, by the way, that's not a good thing for employees. I mean, there's mental health issues there that have to be considered. But these are all things, though, that I think paid time off, unlimited paid time off plans are. I think they're really a great benefit to provide. So anyway, I'm in the middle of writing that. And then, of course, I'm writing a bunch of post-election stuff as well, and my reactions to that. So that's what's going on.
Sounds good. Gene Marks is a CPA who writes weekly on small business for The Guardian, The Hill, The Philadelphia Inquirer, The Washington Times, The Chicago Daily Herald, Forbes, and Entrepreneur. You can also hear him on ABC Radio's Eye on the World with John Batchelor. Gene hosts 2 small business podcasts with Paychex Corporation and The Hartford. Thank you, Gene.
Thank you, Lauren. We'll see you again next week.
Have a great week, everybody.